Hey, good afternoon. Want to welcome you to today's event, the Top 10 Stock Pick Sneak Preview. Today's Monday, November 7th. You got John Hopkins here. Tom Bowley going to be in a quick minute. Hey, if you're new to Earnings Beats community, I want to welcome you. Hopefully you'll find this to be a very useful event. And of course, our wonderful subscribers, thank you so much for your support. A number of you were on our weekend event that was highly attended, had a great response to that. And as a result of that, I know some of you have become trial members, and this will be your second webinar with us. So welcome. Just like all of our webinars, this event will be recorded. If for some reason you're unable to stick around, no sweat. We'll make sure you get a copy of the recording sometime later this evening. This particular event is what we call a sneak preview for the actual top 10 stock picks that'll occur next week. That is a members only event. So if you're on the trial or you're a subscriber, you'll be able to access. So if for some reason you're in this event tonight, which is open to everyone, you'll be able to sign up for a trial membership and get access to all of the picks that Tom provides to our members next week. Okay, with that in mind, we can get this thing going quickly. Let me just make sure Mr. Bowley's in the house. How's it going, Tom?
Hey, John, how's it going?
That's not bad. It seems like we were just in here and now we've got another one going, but I figured, I'll be very brief so we can just get this thing going and let everybody get on to their dinners.
Yeah, I don't think this one will take too long. Of course, that's my famous last words for just about every one of these events.
Yeah.
But I do think this one will go a little quicker. I pretty much have everything laid out. We'll, just the whole purpose is really just give you an idea of some of the things that have driven the performance of the portfolios the last 3 months, different themes, things that have worked, things that haven't worked. And then just to look ahead at some of the things we'll be considering in putting together the portfolios for next week, which includes not just the conditions of the market, but also individual stocks, which stocks have been beating earnings, which stocks look good, which ones don't. And I'll give you, my take on that and how you can kind of start to narrow that down. So we'll go ahead and get this thing started. I'm just going to jump right in. We'll start off with the performance of the portfolios for this past quarter. And just give me 1 second here. All right. Okay, so I'm going to start off here with the portfolio, the model portfolio. And what I've done is I've pulled up a 3-month period. Now, this isn't exact because we started this quarter back on August 19th. So we actually technically go through November 19th. So we still have another couple weeks. So this 3-month look back period is going to start like August 5th through November 5th or August 7th through November 7th. So it's not exact, but it'll give you kind of a sense of how these portfolios have performed over the last 3 months, the stocks that are in here relative to the S&P 500. Now, if you notice the model portfolio, I've also added on within these portfolio chart lists, I've added the S&P 500 so that we can kind of see which stocks have outperformed the S&P, which ones haven't. And I've also got the sector and industry group up here along with the scooter. So we can kind of get a sense for, or maybe be able to quickly recognize why we've either had a decent quarter relative to the S&P or why we've lagged. So here with the model portfolio, this has actually been a pretty good quarter for the model portfolio. Going into today, I believe the model portfolio was up maybe about 3 percentage points, something like that, over the S&P 500 this quarter. Of course, if you could do that every quarter, you'd outperform the S&P by 12% a year, which would be pretty amazing over the long haul. But actually, it's it's almost 5% that we were above on the model portfolio. It was 4.64% that we actually outperformed the S&P going into today. And I think we may have lagged a little bit on the day. Actually, we can pull that up and I can show you. Here was the S&P 500. So it was up almost 1%. We really only had 2 stocks that beat the S&P by a wide margin. That was On Semiconductor and Cadence Design. But we had some that lagged, well, especially one that lagged pretty badly, Deckers. But this is actually a stock with a scooter 86. This has been a pretty strong stock. The other one there down at the bottom, GWW, has also been a very strong stock, 93. So a little, maybe didn't keep up today, but both of those stocks have been pretty good stocks for us. But anyway, I just wanted to look at it because we're probably still up more than 4 percentage points above the S&P 500. So overall, I would say we had a pretty good quarter in the model portfolio. For those of you that are new, we don't try to time the market with these portfolios in terms of cash. We fully invest them every single quarter. Even if I don't like the market, we still fully invest because we take the approach that these portfolios are more designed for folks who are interested in buy and hold. Now, we do swap them out every 90 days. So that's the trading element. So it's really the combination. You're always trying to put stocks in here that are leading stocks within leading industry groups, hold them for 90 days, and then we rinse and repeat. We go through that same process. So if you decide, hey, I want to follow portfolios, but I want to be 50% cash, well, then the solution is only put 50% into each one of the stocks, if that's, again, what you want to do. We are not registered investment advisors. I'm not advising you to do this. We keep these portfolios for educational purposes only, just to show our members that if you stick with leading stocks and leading industry groups over time, you can outperform the S&P 500. And dating back to almost 4 years ago now, I can't believe it's been 4 years since we started the model portfolio. But prior to today, the model portfolio over the 4 years is up 111%. The S&P 500 is up 40%. So it's nearly tripled the S&P 500 over 4 years. So again, it's educational in nature. It has not outperformed the S&P 500 every quarter. We've had some rough quarters. We've had some really good quarters, obviously, but we've also had some rough ones. Investing isn't it's not a situation where you're going to be right all the time. It's just not. There's just no way. I don't know anyone who is right all the time. I don't know anyone who picks all the right stocks, all the time. It's just impossible. The point here is to try our best from a reward to risk perspective to win more often than we lose, no matter what we're doing, whether it's portfolios, whether it's trading, whatever it is. The whole idea is to try to minimize our risk as best we can while sticking with things that work. So anyhow, over the last 3 months, you can see we've had a pretty good run in the model portfolio. Now, if I move on to the aggressive portfolio, actually, already got that set up for you. Here's the 3 months. You can see this was a different picture. And much of this weakness in the aggressive portfolio has occurred here in the last couple of weeks. It's this earning season that has hit us on some of these stocks. And the aggressive portfolio prior to today was trailing the S&P 500 by about 2.5%. And it was not a good day today. It's probably down another 2.5% today. It's probably down 5 or 5.5% this quarter. Since its inception, however, which was back in May of 2019, the aggressive portfolio had gained 82% prior to today. And the S&P over the same period went up 32%, 82 versus 32. Again, pretty nice longer term performance. But again, today, not a great day for this portfolio. If you look, we had 4 stocks that have beaten the S&P this quarter, and then we had 6 that underperformed. But we had some really big underperformers, and that's what's really killed the portfolio. We've had a few, like I said, just in the last week or two. Wolfspeed was one of the best semiconductor stocks until about a week and a half ago when they came out with their earnings, had a big gap down. It's been trading down since. That one has not been a good one. Lemonade Just recently, today actually was a bad day for the stock, which has taken it down quite a bit. Synopsis, and then the other one I had was LNTH, which was Lantheus Holdings. And you can just see that this one's rolling over, couldn't get through the previous highs, starting to pick up some volume to the downside, hopefully holding on to this $55 support right here. But like I said, this is, look at how much it's dropped. It's gone from 75 to 55 in the last 5 days. So there have been some big hits to the aggressive portfolio here, mostly since the Fed met last week. Not all growth stocks are getting hit like that, but there have been a lot that have been hit. We'll see whether or not that continues. And that'll be part of what we have to decide in terms of putting together the portfolio for the next quarter. So that's the aggressive. The income portfolio this quarter is actually up by 3 percentage points over the S&P 500 prior to today. And there were a few reasons why, but here's the S&P 500. Here are the 5 stocks within the income portfolio that have done well, better than the S&P, and there are 5 that have done worse. But of the ones that have done worse, Nexstar Media and XST, they actually report. I want to say tomorrow, but they're reporting this week. NXST down 11 percentage points from where they were, or from where the S&P 500 was. But NXST this was a $190 stock, by the way, 2 weeks ago, probably about 2 weeks ago, $190. 155 today. It's down $35. And Scooter just falling apart. However, when you look at these stocks, like I said, this one's down 11% from the S&P. Apple, last week was horrible for Apple. It's now down from the S&P by about 7 percentage points. But if you look at the 2 big winners here, Unum, which is a life insurance company, and then Genuine Parts, an auto parts company. These 2 have crushed the S&P 500, so much so that the overall group has been able to outperform. So we are seeing some outperformance there. Since inception on the income portfolio, which also was the inception was back in May of 2019. So it's been 3.5 years. We trail the S&P 500. The income portfolio has gone up 18% prior to today. And the S&P is up almost 32%. So we're down 13, 14% for percentage points. But I would expect, with the way that we put our portfolios together and based on what I think is going to be a continuing secular bull market going forward, I would expect income stocks to underperform over the long term. So I'm not surprised that the income portfolio is underperforming. We try to, again, provide stocks that are showing really nice relative strength, and we change it out every 90 days. We include only companies that are paying nice dividends, for the most part, at least 1%. Some of these might be 2, 3, 4, 5% dividends. Anyway, you can see a little bit of outperformance this quarter, but overall, this one has lagged the S&P 500. So those are our 3 portfolios. And the whole idea is that next week, all of these stocks will be removed. Maybe a couple will survive, but they're going to be replaced. Each one of these portfolios, income, aggressive, and model, they will all be replaced by fresh companies. In order to be selected, you must have beaten Wall Street estimates in your latest quarterly report. You must have beaten Wall Street estimates as to both revenues and earnings per share. That's litmus test number 1. And that dates back for me to when I was in public accounting. I just think if management tells you that we're going to earn X dollars and we're going to have so much in revenues, I'm going to trust your forward-looking numbers if you can beat the numbers you provide this quarter. I mean, if you come out and you tell me, hey, our earnings are going to be $1 a share, and then they come in at 85 cents and you miss, how can I believe that you're going to have 20% growth the next 5 years? You couldn't beat the current quarters. And so that's where I think valuations can be impacted on Wall Street. You've got these big firms, they don't like misses. You know, they're trying to put together what they believe are honest valuations of companies based on future projections. And if you can't get the current quarter right, why should we trust what you have out there for the next 3 to 5 years? And that's with growth companies, especially, that's important in valuations. Being able to rely on those numbers. That's the one thing, you know, you can pretty much count on with Apple. When Apple comes out with their numbers, they usually beat. And so when they give you their forecast of what they expect going forward, you can assume that it's fairly conservative, because quarter after quarter after quarter, for many, many years, Apple has beaten estimates. And so the whole idea with putting these portfolios together is trying to find companies, number one, that actually do what they say they're going to do and even exceed it. Those are the types of companies that we want in these portfolios. So that's test number one. You have to beat on earnings and revenues in your last quarter. If you matched or if you missed either one of them, you will not be in our 3 portfolios. I don't care I don't care if you're Apple, I don't care if you're Tesla, I don't care what company you are. You won't be in our portfolios if you don't beat top and bottom line estimates. Second thing that you've got to do is you've got to be a liquid company. In other words, we don't want companies who posted great results but trade 3,000 shares a day. I mean, our members, if everyone decided, hey, we want to get into these portfolios, we want to make sure that we have liquid stocks so that everyone's not trying to get out at the end with no market being out there, with hardly any buyers. I mean, if everyone's trying to get out at the same time and there aren't any buyers out there, I can promise you market makers are going to be taking advantage of everyone. So you got to have liquidity. You don't want to worry about how you're going to get out of a stock. And I think that applies, for me, it applies to any trade I make, not just getting into portfolio stocks. So that's number 2. And then number 3, I really prefer having companies that are leading stocks within their industry group. And then their industry groups, I like to have leading relative to the S&P 500. In a perfect world, that's how these portfolios be put together. Now, it's not always perfect, but we tend to stick pretty closely to that strategy. And then, like I said, when you look at our long-term results of these portfolios, I think, you know, there's a reason to be optimistic with this strategy. All right. So anyway, that's where that's, you know, how the portfolios have performed the last 3 months. We've got through next Friday. So we still got another, 9 trading days to go before companies will be replaced. We got another big CPI report coming out on Thursday. Couldn't tell you what's going to happen. Got the election tomorrow. I have no idea what's going to happen there as far as how the market may react. So we've got some things to consider. We've seen growth stocks getting hit on a relative basis again recently over the last few weeks, especially last week after the Fed announcement. It was horrible for growth stocks. So we got that to take into consideration. We've also got the historical period. So the best time of the year historically over the last 72 years, October 27th close through January 18th close is the best time of the year to be in the stock market. Again, that's looking in the rearview mirror. That's the past. But from October 27th to January 18th, the S&P 500 has moved higher 62 times in the last 71 years. If you're just looking at where we were on October 27th and where we finish on January 18th, just comparing those two values, we're higher 62 of the last 71 years. 62 wins, 9 losses. So if you think the market's going lower, I'm not saying it'll be unprecedented. We've had 9 times where it's happened since 1950, but it would be unusual. Market normally goes up. If I look at the sectors over, actually, let me go back here because this was a 10-year treasury. I wanted to show you the 10-year treasury yield and talk about this a little bit, because this movement up here, I don't think growth stocks were spooked some, but I don't think they really became overly spooked until we started to shoot higher this year. And you can see, and when I say growth stocks, I'm talking about looking at the NASDAQ relative to the S&P 500. The NASDAQ is much more heavily weighted in companies like Apple, Microsoft, Tesla, NVIDIA, AMD. I mean, these are the companies, Netflix, and so on and so forth, Amazon, Google. All these companies are more heavily weighted on the NASDAQ than they are on the S&P 500. Some of them double. So when they're not performing well, and as rates keep going higher, that kills growth stocks. Number one, it kills valuations just because when you use the higher interest rates to discount future earnings, you're going to come up with valuations of companies that are a lot lower. For those of you who aren't familiar, I was a practicing CPA for 20 years in the Washington, D.C. area. So I was head of our firm's accounting and auditing committee. I was, I did a lot of audits. I know fundamentals pretty much inside and out, which I think is one advantage I have over a lot of technicians. I really understand the fundamental side of things. And if there's one thing you have to understand, that's why when interest rates get up to certain levels, people start reallocating away from the stock market into the bond market. I mean, if rates keep going up, if you can lock in 6-7% guaranteed, is it worth the risk to be in the stock market? For a lot of people, the answer is no. It's not worth the risk. I don't care if the market goes up 10 or 15%. I can get 6 or 7% guaranteed. People will start bailing from the stock market at some point. Some have already bailed to take 4% 10-year treasury yield. So, I mean, these notes are backed by, our government. To date, there's been no default. So pretty safe return, 4%, not have to worry about things. When we were at 1%, 2%, didn't make sense to be in bonds. I mean, especially with rates that low. I mean, this right here is when we saw the growth stocks absolutely explode. And part of it is because, again, when you have rates that low and you're discounting future earnings back at extremely low interest rates, valuations are off the charts to the upside. So this is a big part of the problem right now, is that rates, it's not that they're going up, it's that they've been going up rapidly, and now they're moving into territory where you can start to see reallocations. And if folks start bailing on the stock market to move into the bond market, then you're going to see the stock market continue to struggle. My theory is this isn't going a whole lot higher and rates are going to come back down, which in turn will send growth stocks higher. But I could be wrong. It's just what I believe. It's my opinion. As I look at this chart on the weekly chart, even though we have been going straight up, we do still have a negative divergence on this weekly chart. So if something were to come out, whether it be a CPI report, whether it be some other economic reports, whether it's the Fed starting to talk, maybe a little more dovish, if you see a big reversal here in terms of a candle, maybe a big red filled candle that goes back down, maybe below 390, that could very well be the indication of a top with a negative divergence, reversing candle. Those types of things can be very significant marking tops. That's what I'd be looking for. But the 10-year treasury yield is playing a big role and has played a big role in our performance in our portfolios and in the stock market performance overall. Rates keep going up. I've said before, you get to 4 or 5%, you can still handle it. You get much above 5%, I think that would really spook the stock market. And some of it's been built in. But if we were to shoot through 5%, I could see us going significantly lower on the S&P 500. So keep that in mind. Sector summary. So this was the other thing, the other theme. When you look at portfolios, it's not just, the S&P 500 went down X%, I went down more. Therefore, it was bad selections. Well, at the time, maybe it wasn't a bad selection. But when you start to look at the performance of the sectors and you see how you allocate in your portfolios, you can begin to understand why you underperformed or why you outperformed. It could be that you invested in all the right areas and just simply picked the wrong stocks. That can happen. Or you could be invested in some of these really bad areas, but happen to be in some really good stocks within those areas. That's a little bit of what happened with the model portfolio. I mean, we had ON Semiconductor, which turned out to be okay this quarter when it's been part of the technology sector there. And if we look at the semiconductors over the last 3 months, semiconductors are down 20%. ON over the last 3 months is probably close to flat. I haven't looked at it to see exactly where it was 3 months ago. But that's one that's in our model portfolio that hasn't hurt us. And it wasn't because we had a great area of the market. It was because we had a really good stock within that area. The aggressive groups, we're seeing some of the opposite right now. We're seeing some stocks that have really weakened considerably in some areas that weren't that bad. I think it was, which one? Lemonade, property casualty insurance. This stock's down 20%. You know what property and casualty insurance has been doing? If you haven't, let me show you. It's in the financial space. There's property and casualty insurance up 10% in the last 3 months. So that's an example of where I was in the right group, picked the wrong stock. It's going to happen. It's going to happen both ways. But at least by going through this process and picking stocks based on the themes that you believe in, based on the areas of the market where we're seeing strength, you can at least at the end of the day, look in the mirror and say, okay, this is why I underperformed, or this is why I outperformed. All right, so a lot of talk right now about the Dow Jones and how the Dow Jones has been outperforming the NASDAQ. Well, did you know over the last 10 years, we broke out in April of 2013 above on the S&P 500, above the 2000 high and the 2007 high. It happened on April 10th, 2013. That's when we finally cleared. So if we look back at the last 10 years, essentially, we're looking at what I consider to be the secular bull market. During this secular bull market, what I've done here is I've shown you the Dow Jones versus the NASDAQ. And if you look back over the last 10 years and add, this is relative outperformance, which would be positive, and relative underperformance, which would be negative. If you look at the first 8 months of the year, January through August, no month have we seen the Dow outperform the NASDAQ more than 50% of the 10 years. So for instance, in February, the Dow has outperformed the NASDAQ 5 of the 10 years, 50% of the time. January, only 3 out of 10. July, only 2 out of 10. So you can see, not very often. And if you look at the average underperformance coming across here, every one of these is negative except April. So if you add them up, it's -1, -1.3, -1.4, -1.1, -2.3, -3.1, -5, -6.4. The Dow from January to August has underperformed the NASDAQ by 6.4 percentage points on average each year over the last 10 years. That's a lot of underperformance. But notice when you get to September, all of a sudden the Dow outperforms. So what we're seeing in November right now is not really that unusual. The outperformance, maybe the level of outperformance might be a little bit unusual. But look, I mean, December, we haven't had any December yet in 2022. So we're only looking at the last 9 years here, but 7 of the last 9 years, the Dow has outperformed the NASDAQ in the month of December. And it's really easy to understand why. If you look at the XLK and compare that to the S&P 500 over the same 10 years, I mean, it's about even. There's actually, maybe it's one of the individual industry groups. Yeah, that one actually hasn't. Semiconductors haven't done too bad in December. Look at semis. Semis normally outperform during the month of November by a pretty big amount, 3.2% on average. Look back, and May is the only other month where we see this kind of outperformance by semiconductors. And so if you pull up the semiconductors right now, look at what we're doing here in November. We closed today at the highest level in a month. Semiconductors are actually starting to look pretty decent on this chart, although I really want to clear 5750. I want to clear this high right here. But we're on the verge of this neckline being taken out on a bottoming head and shoulder pattern on semiconductors. Well, that's worth knowing, especially when you know that November tends to be one of the stronger months for the group. And so if we pull this up, and actually I'll just pull up on, which is a semiconductor, and then I will pull up this relative strength chart. So I was wondering where on was. Looks like, yeah, we're about even where we were 3 months ago for on semiconductor, which is pretty good considering semiconductors are 20% lower. But look at the relative strength of semiconductors as we start November. We're starting to strengthen. That's historically what we tend to do. So as I go through and put these portfolios together, it's about looking at earnings, the fundamentals. It's about looking at the technicals. The other thing I like to do is look at the sectors relative to the S&P 500. So this is going to be part of the analysis. Technology looks really weak right now. So does discretionary. So does the communication services group. But look at industrials. Look at financials. I mean, financials have just broken out now to a multi-year high, about a 3-year relative high. Industrials, more than a 3-year high, going back probably 3.5 years since we've been at this level relative to the S&P 500. How about healthcare? Look at healthcare. 5-year. I think that's an all-time relative high. Healthcare has never represented more within the S&P 500 than it does right now. So you got to be aware of that. How about energy? I mean, it's going to be hard to ignore energy next week with the way energy's been performing. The problem with energy, when you put one stock in to a portfolio where you only have 10 stocks, energy is then being weighted 10%. Energy is only about 4% of the S&P 500. So if energy underperforms all of a sudden, you've got 10% of your portfolio in energy, which is 2.5 times, the representation within the S&P 500. That's the problem. So if I were to do an energy stock, it might go in something like the aggressive portfolio, because I think that's an aggressive trade or an aggressive part of the portfolio to have 10% within energy. But I'm going to look for one of the stocks that I feel like, looks great in terms of relative strength. And hopefully over the next 3 months, that does well. Let's go back to seasonality here for a second. Here's the financials. So you've got financials relative to the S&P 500. This was in the report the last 2 months. I think in October, I may have talked more about industrials, but financials love the month of October, and they also love the month of November. So when we're looking at something like the XLF, and you see this in October and November, we shouldn't be too surprised. If you come down here and we look at it on a relative basis, look at it taking off October and November. Actually got a little bit of an earlier start. It was going down in August and September, but it was outperforming the S&P. Why? Well, Wall Street was probably rotating into those two areas with the anticipation that we were going to see more of this, which we have. So I think seasonality plays a role in this as well. Here are the industrials, last 10 years. Look at November. industrials relative to the S&P 500, 9 out of 10 years. Let's keep taking this back. There's 10 out of 11, 11 out of 12, 12 out of 13, 13 out of 14. And we don't drop again until all the way back here. 13 of the last 14 years, industrials have outperformed the S&P 500 during the month of November. So should we be shocked that we're seeing this and that we're seeing movement to the upside? So this is a part of what needs to be considered. So it's fundamentals, it's tacticals, and it's also seasonality. All these things, I think, need to play a role in determining what you want to put into a portfolio. All right, the last thing I wanted to talk about was, well, this is the relative strength of the sectors, but this is just today. So we can see communication services, energy, and technology were the three best relative performers today versus the S&P 500. So it just means that they went up more than the S&P. If I go over here to the sector summary and we do this intraday, whoops, let me go back to the sectors. All right, so now we do this intraday. There's communication services, 1.79%. So it is up on an absolute basis, 1.79%. On a relative basis versus the S&P 500, it's 0.82% higher today. But we can go back and you can look at this and say, okay, what about the last week since the Fed? Remember the Fed last Wednesday. So look at what got killed last week. Communication services, technology, consumer discretionary. I mean, that needs to change for the stock market to have a meaningful rally. We've been struggling in these three groups and the S&P is going sideways, which actually isn't too bad considering how bad these groups have been. You'd think we'd be breaking back down, but it's because money is not necessarily leaving the stock market at this point. It's simply rotating to some other areas. If rates keep going up, that's when I think the overall market could really begin to weaken again. But I think rates are going to have to go probably up to, I mean, we go back up past the recent highs, it's going to spook the market. But I think for something to really become meaningful, I think you got to go above 5%. I think anything, if you look historically, anything below 5%, historically, the stock market has been able to do very well. But part of the problem is not the level of interest rates, it's how fast they've gone up. And I think that is what is creating these valuation nightmares for some of these aggressive areas like software, semiconductors, internet stocks, areas that traditionally have, can produce significant earnings increases. Earnings can accelerate, the growth rates can accelerate in those areas. They also, when the markets, when it's more difficult, when they face headwinds, like with higher interest rates, they also can lower valuations very, very quickly. And that's always, that's nothing new in the stock market. That's always been the case. So that's 1 week. We could go back 1 month. And you can see again, consumer discretionary communication services down on the bottom, technology a little bit better. Go back 3 months. There we have consumer discretionary communication services on the bottom. So it's been a tough environment for some of those growth stocks for the last 3 months. And I believe, let's just pull up one of these. I just want to go over here for a second. Yeah, I mean, if you look at the ratios here, the S&P 500 during this move back down, look at the XLY versus the XLP. We're back down now, right to the lows that we saw back in May. You look at the QQQ relative to the spider, breaking down again. IWF versus the IWD. This is large cap growth versus value, breaking down beneath that May low. These are all negative developments that have taken place over the last 3 months. And again, it all, in my opinion, boils down to this right here. Look at what the rates have done the last 3 months. August, September, October, right there. We've gone from 250 at the low, beginning of August, to 421. That's up, that's a 1.7% increase 170 basis points in 3 months. Too much. So this is going to be the key. And if, our CPI report on Thursday comes out hotter than expected, you could see the 10-year treasury yield jump. And if it does, we could see another leg to the downside. I don't know if we go back below where we were at the time of the last report. If you look at something like the NASDAQ 100, here was that low, 10,500. Right now we're at 10,977. So we have roughly 5% down to that recent low. If you look at the S&P 500, we're at 3,800 now, closed at 3,806. We were down under 3,500. So we got 300 points. That's what, from 3,800, I don't know, maybe 8%, something like that. So 5% on the NASDAQ, 8% on the S&P 500. And then, of course, the Dow, which has been the best performer of all, has a lot more room. 32.8 all the way down to, I don't know, 28. Let's call it 28.8. That would be 4,000 points from 32.8. That's now we're talking about maybe 13, 14% that the Dow would have to drop to get all the way back down there. But again, that relative outperformance that we're seeing on the Dow right now, this is kind of traditional this time of the year. So how much of this is based on, the fact that the market's concerned about rates going higher? How much of it is based on the fact that this is what we tend to do at the end of the year? Market tends to go higher, and it tends to be led by the Dow and the S&P more so than the technology-laden NASDAQ. All right. The final thing that I will do, I talked about wanting to find leading industry groups. Well, here's the relative strength industry group chart list that we have. And if you're a member of Earnings Beats and you're also a Stock Charts member, you can download this. I think we give this to our annual members. So if you're an annual member, which, by the way, we have a fall special coming up in a week. If you're an annual member, and all you need is really a trial membership over at Stock Charts, and you can download this chart list, which has all 104 industry groups set up relative to the S&P 500. And then you can simply pull this chart list up in summary form and see over the last 3 months, here are your leaders over the last 3 months. Of course, oil. If you look, XLE, 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 4 of the top 5 are in the energy area. Not surprising there. And the one that's not is renewable energy, which is now in the technology sector. But either energy or renewable energy in the top 5 spots right now. What's not leading? What's not been working? Internet, worst performing sector over the last 3 months, or industry group. Broadline retail, autos. There's your semis down here in the 7th spot. There's software, 8th. These are the groups that have not been working the last 3 months. Part of it could be seasonality. I think a bigger part of it's interest rates going up. So how much risk do we want to be in these areas? Well, I think we want to be in. I just don't know how much we want to be in. And when we are in, we want to find leading stocks. So if you're looking at an internet stock, what you don't want is something like Meta versus the S&P 500. Let me show you what that's been doing. And even versus its peer group, if we just look at it versus the internet space, it's been one of the worst stocks within internet, and internet's been the worst area in the stock market. So do you want to have Meta platforms in your portfolio? I say not a chance, 0 chance. I want the opposite. If I'm going to have a stock that's in the internet space, first thing maybe to do is, let's go over here. Let me show you how I would do it. One way quickly to do it would be to go to the Scooter reports right here. Click on that under the member tools, and then come in here and just type in internet. And you can look at the scooters. Top scooter is Twitter right now. And then under that's Netflix. Netflix actually doesn't look bad. Netflix has been pretty good. Pinterest, yeah, scooter's 38, but it's actually showing much more relative strength. So let me pull that up and show you here. So here's Pinterest. Look at Pinterest relative to internet. Last 3 months, it's been really strong. It's actually been holding its own. The problem is not Pinterest. The problem is its group. So internet stocks are holding back Pinterest. There's not as much money going into internet stocks. The money is rotating out of internet stocks. So if that's the case, it makes it really hard for a stock like Pinterest to move. But if I'm going to put a stock, if I'm going to look at one of the stocks in the internet space, I would be interested in looking at a stock like Pinterest. If it meets all the criteria, beating top and bottom line, we know it's certainly liquid. Technically, I mean, this is what I'm looking at. I'm looking at the relative strength. AD line just set a 52-week high recently. I mean, I think Pinterest looks pretty good. Just went back down, tested gap support. But the problem is internet. If internet starts to rebound, here's one of your leaders. I think Pinterest could do really well. How much risk do you want to take? Well, that's up to each individual. You know, you pull up something like Twitter. Now, Twitter's just all over the place. This isn't so much to do with earnings. It's, you know, all the fanfare that surrounds Elon Musk and the acquisition of Twitter, and then the failed acquisition, and then the acquisition's back on again, and now it's taken place. So Twitter, because it's already been bought and it's basically going nowhere, I could eliminate that pretty quickly. And then the other one's Netflix. So let me show you Netflix. Now, Netflix, remember, gapped up above this double, 250 was a tough area. You know what today's low was? 252. After being up over 300, it's come all the way back down. I could argue current price down to this 50-day moving average could be an accumulation area. If closed below the 50-day and this gap support area down at 240, you get out. Otherwise, you use this as an accumulation zone. Because I think Netflix looks to me like it's been moving higher. This is one, look at the relative strength versus internet. And of course, we know long-term, Netflix has been a great stock. It's just it went through a rough year, very, very, very rough year. But things starting to pick back up again. I think Netflix looks really, really interesting. And if you want to look at internet, mid-cap stocks, just there you got now TripAdvisor is the number one scooter. So you can go down and take a look at these charts, see if there's any that, interest you. And then small caps getting even more and more aggressive. But some of these, Media Alpha, Max, 97 scooter, VTRU, 95 scooter. Look at all these high scooters in the internet space. So anyhow, that's how I'm going to go through and try to decide for next week which stocks we want in our portfolio. I'm going to be looking at the technical side. I'm obviously looking at the fundamental side. They can't be included unless they've beaten in their latest quarterly results. They had to beat top line and bottom line, revenues and earnings per share. And then also I'll be looking a little bit at the groups, trying to find some of the top groups on a relative basis. I'll be throwing in seasonality, and I'll be looking at some other things. We've got another CPI report coming up on Thursday. What clues is that going to provide us? How is the 10-year treasury yield going to trade between now and, or not the yield trading, but what's the 10-year treasury yield going to look like over the next 10 days before we, has it broken out? Are we back at 440? Or have we had one of those big reversal days where maybe we're back down under 4, maybe under 390? That's going to play into it. What's the dollar looking like? If the dollar is strong, if I think the dollar is going to be strong, some of those multinationals aren't going to do so well, but the dollar's been coming back down recently, and we're seeing a lot of those larger cap multinationals on the Dow and on the S&P outperform. How much longer is that going to last? All of these things are going to be factored in. Anyhow, John, that's basically what I had for tonight. So I don't know if we have any questions.
Yeah, somebody made the comment, if discretionary is so bad, why is the XRT SPX holding up?
Well, there's a lot more than just retail. But let's take a look at it. I haven't looked at the XRT recently. Yeah, I mean, it's been going flat here recently. I wouldn't exactly say it's flying to the upside, but it's flat. Personally, I think that is an indication that, we keep hearing in the news a lot about, recession ahead, perhaps a bad recession. Well, retail stocks really don't suggest that based on what I'm looking at. If we go up here, let me do it this way, XRT. Actually, that may have been where I got it. Is that where I just typed it in? Yeah, never mind. So let's go down here and we'll just change this. I mean, retail stocks tend to go up and down. There aren't too many retailers that are great long-term buy and hold. But I'll show you what I'm talking about here in just a minute. Let me switch this over to price. Actually, I don't need to do that. Let's just get rid of that. So we got let's go back 10 years. We'll make this weekly. So if you look at the XRT, I mean, we had a great market going in, 2013. Remember, that's when we broke out. We had a great bull market. Retail didn't lead it. Now, if we just pull up the XRT by itself, not on a relative basis, we went up in 2013, we went sideways, pulled back a little bit, and we had a nice rally. So you can see from the start back in 2013 to where we are right now, retail's gone up, but it has not been a good performer relative to the S&P 500. So I don't use retail as an indication necessarily about, whether the market's going to go up or not, because again, we had multiple years in here where the stock market went up and retail did not lead. Retail underperformed. And, starting in 2021, most of this leadership right here was a lot of the online retailers, because we went through that period. We had the initial drop with the pandemic, but then we absolutely soared. A lot of the specialty retailers, if you remember, Amazon doubled in a short period of time. A lot of the retailers did really well. And now that's changed and we're coming back down. I don't really take too many clues from the XRT or from many of the retail stocks, because like I said, most of them have periods where they go up and then they have periods where they come right back down. I mean, if you look at them long-term, I look at something like Ross Stores. This is one that's been pretty good over the long term. We could probably even go back further, go back 20 years. So obviously Ross Stores has been a really good one. You've got Amazon, of course, that's been a tremendous performer. But I mean, let's see what else we got. Like Dick's. Look at Dick's. Goes up, pulls back, goes sideways for a while. Then it has another big move, and then it's kind of coming back down. I mean, some of the other like apparel stocks, something like Chico's. That's one of the stocks we like right now because it's been a pretty good performer recently. But look at the stock over the years. I mean, up, then it gets killed, then it soars, and then it goes sideways, then it gets killed, then it soars. And where are we right now? We're $6. Where were we 20 years ago on Chico's? $6, $7. So, a lot of these companies that are in these areas that go up and down, they're just not good long-term buy and hold. You trade them when they're hot and you get the heck out of them. Unlike Amazon, which I think is a stock that you can buy and hold if you're a buy and holder, or you can trade it, while it's going up. When it rolls over and starts to go sideways, just simply watch from the sidelines until an uptrend starts again. So anyway, hopefully that helped.
Yeah, a question came up that I really answered, but you might add a little flavor to it. Someone said instead of generating a new portfolio of 10 stocks every 90 days, might you consider doing it every 30 days? And my response was, we do it specifically for 90 days as it represents a quarter. However, we do reserve the right to change it up, if it's warranted, which I think we did one time, right?
Yeah, it's, the the big thing, I think you hit the nail on the head, John. I mean, the whole thing is based on the earnings season. We pick these stocks after we go through an earnings season. So for us, it just seems natural that you would want to do this quarterly as opposed to monthly. The other thing is what we were trying to do when we established this, we have a lot of tools and we do a lot of research for traders. The whole, when we started this back in 2018, it was as a result of members writing in and basically saying, listen, I don't want to trade often. Can't you just give me, your 10 best picks that you like? And just, let's just go with those, for a period of time. And that's how the portfolios were born back in November of 2018. We started with the model portfolio, which I just said, okay, here are the 10 best. These are the 10 that I really like. These are leading stocks within different leading industry groups. And so there's a little bit of diversification, although that was mostly growth stocks. And that's a disclaimer right now. We invest mostly in growth. We did change things up a little bit in 2021 and 2022 because of the pandemic and just because the rotation was so dramatic out of growth at times that we just didn't want to have that kind of risk going in. There are a lot of other growth funds and growth investors and so forth that have just stuck with their principles and they've gotten absolutely slaughtered. I mean, obviously the ARK funds and Kathy Wood come to mind, where they never changed anything. They just kept buying the same stocks over and over again while they were in free fall. And so we did change that. And as John mentioned, we did have one quarter where we went in mid-quarter because things were starting to change and we just wanted to change with it rather than wait and get crushed again for another entire quarter. So we have done that, although that is not going to be the norm. I think once we get, we're getting further and further away from the pandemic. I still think we're being impacted by the pandemic in terms of the inflation. We still haven't caught up on the supply side just yet. I think that will happen. I thought it would have already happened. It hasn't, but I do think it'll happen. And when that happens, I don't look at changing up portfolios during the quarter. I mean, you can do whatever you want, but we hold them for 90 days. So we're transparent. It's simple. And for someone who is working, doesn't want to be, getting text messages and emails about get into this one, get out of that one type of thing. Just going in every 90 days is easier. And I think it is more appealing to people who don't follow the market every single day. The other thing is, I think it's irresponsible. When we put stuff out and we talk about a stock that looks good at a support level, we're doing all of that for educational purposes. We are not registered investment advisors. We've had members who have said, why don't you provide us, setups and trades and, just tell me what to buy and what to sell. Well, you need a license for that. You need to be a registered investment advisor. That's number one. Number two, we have a lot of members. Some people are very conservative, probably stick to ETFs or maybe invest in some of the large cap names, maybe only the dividend payers. And then we have others who might be willing to shoot for the fence, and gamble almost. But we can't just put trades out one size fits all. I mean, it's not really a smart thing to do with members really looking for different things. So what we try to do is educate. And if you're somebody who is really shooting for the fences, there are ways with the chart list that we provide to go in and be much more aggressive. You've got ETFs. We try to teach about when to get into juiced ETFs, those leveraged ETFs. I don't believe they're designed to buy and hold. Some may disagree and that's fine. But if I'm going to do those leveraged ETFs, I want to do it while I'm in a trend. If I'm trending higher, that's when I want to be in a leveraged ETF, not when I'm trending lower. Unless I'm going to be on the short side, which right now, we've kind of moved beyond that. I'm not really looking at shorts at this point. Anyway, that's a long-winded answer to the question, but I think you pretty much nailed it.
Okay, so that pretty much concludes questions. We'll make sure everybody gets a copy of the recording and a reminder you like what you heard tonight, and you're not either a full subscribing member or a trial member, sign up for a trial, and you will get access to next week's top 10 stock picks where Tom releases these 30 stocks. So that's something that I think they might want to consider, Tom, and I'll let you wrap it up here.
Yeah, I mean, and people have asked me, I want to be 100% transparent here. People ask me, do you own all of the portfolio stocks? Do you follow this system yourself? My answer is no, I do not. And the reason I don't is because that's not my trading style. I don't buy and hold for 90 days. I think it's a great strategy for those who don't want to be active in the market. But I will say this, a big percentage of my stock trading is in the stocks that are in these portfolios. These are the stocks that I like to trade. Why? Because they're leading stocks and leading industry groups. This is what I like to trade. So I look for them when they pull back and they hit the 20-day moving average, or maybe hit a key price support level, kind of like I was showing you with that Netflix. I mean, Netflix is not in our portfolios right now, but if I'm looking at Netflix and let's say this was a portfolio stock, I mean, I'm looking across here and I'm seeing big resistance at 250. And then we gap up, we go over 300. When we come back down to 250, that to me, from a trading perspective, is a great time to get in, because now I can keep my stop fairly tight. And if it truly is uptrending and it bounces off this support level, my money immediately starts working for me. If I was in before, let's say this is a portfolio stock and I get in here at 270, yeah, I'm excited when it's at 300. But then when it goes back down to 250, I'm not going to be excited at all. All my profits vanished. And as a trader, to me, that's unacceptable. I'm not going to hold a stock from 300 down to 250. It's just not going to happen. So I think it's we have a lot of different, chart lists and strategies for lots of different types of traders and investors. We are not a one-stop shop that, hey, if you're a day trader, come in, otherwise we can't help you. I think we can help everyone. We certainly can help everyone learn more about the market. So that's the approach. I just want to make sure I'm clear, because I get that question all the time. It's always coming up. Why don't you own this? If this is your portfolios and it's done so great, why don't you own them? Well, that's not my philosophy. It's not my strategy. I trade much more short-term oriented than buying and holding for 90 days. But our members can do anything they want. You can be into these portfolios and you can put stops in if you want. We don't keep stops. We did that early on and it just got too confusing. We had members writing in and say, well, I didn't see that, now it's down another 20%. I didn't realize that you had a stop in there. I thought these were designed to hold. So basically it's buy and hold 90 days. That's what we do. Now you can do whatever you want with them. But I think at least hearing which 30 stocks are in these portfolios, I think is worth the price of admission to earnings beats for the year. But that's my opinion. Anyhow, let's go ahead and wrap up. Appreciate everybody tuning in. Again, just want to remind you, we are going to have our fall special starting later this week. And that is going to be the best deal that you're going to get all year long. So make sure you check your account out, see where you stand in terms of how much you have left. If you are an annual member, you may want to check and see when your expiration date is, and make sure you re-up when you get the best deal possible. And again, that will be during the fall special. Have a great night, everybody. I'll be back in the morning. You can go over to Stock Charts TV and click on that at 9 a.m. and listen to my latest Trading Places Live show. And I'll be back at Earnings Beats on Wednesday morning for the next Trading Places Live there. Everybody have a great night. Happy trading.